am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the major developments in the banking space. It is the 28th of December and I am Ruchika Chitravanshi. In today's episode, our cover story explores why RBI is clamping down on alternative investment funds. For the Banker's View this week, we have Danat Dubashi, Managing Director and CEO of L&T Finance Holdings Limited. In the Banking for You section, we will explain what the evergreening of loans is. Our consulting editor, Tamal Bandhopadhyay, will join us to discuss issues around fintech and financial inclusion. At the end of the show, we will tell you the results of last week's poll and the question for this week. The Reserve Bank of India issued a circular on 19th December barring lenders from investing in alternative investment funds linked to borrowing companies so as to prevent the evergreening of loans. But why is RBI clamping down on AIFs and what will its impact be? Kasturi Akhil finds out.
Last week, the Reserve Bank of India barred banks and non-banking finance companies from investing in alternative investment funds to prevent questionable asset transfers. The Apex Bank took this measure to prevent the evergreening of stressed loans. As a result, all regulated entities are required to liquidate their investments in alternative investment funds or AIFs within a 30-day window if the fund has an investment exposure in the company that also has a loan exposure from the regulated entity in the past 12 months. In simple words, if Bank X, for instance, has lent 100 crore rupees to the company Y, and meanwhile Bank X has also invested in an AIF, that in turn has invested through debt or equity in company Y, then with the recent circular called Investments in AIFs, the RBI has prohibited this relationship. Bank X in this case has 30 days to liquidate its investment in AIF. However, if it fails to do so, it will be required to make 100% provision on the investment. How will the latest move impact the lenders?
There is already a cap on banks about how much they can invest in the alternative investment funds, while there is no such caps existing for NBFCs. So banks have a cap of 10% of the total fund. So I see that banks may not be that worried. While in the case of NBFCs, as of now, there are only two funds, two NBFCs who have reported their exposure to such, funds, and they have already started provisioning it. Other than that, we really do not have a data as to see what is the total exposure of Indian NBFCs to such funds. So having said that, in my view, only about 5-10% of the total inflow of alternative investment funds comes from banks and NBFCs, that is financial institutions. So for banks and NBFCs, the impact may not be that huge.
As per reports, experts from the AIF industry expressed their disappointment, claiming that the new norms will extensively reduce investment prospects for AIF as an industry, and they might lose business to a large extent. As when a bank invests in AIFs, and if that AIF invests in a listed company, the new rules will deter the company from doing any business with the bank in the 12 months preceding the AIF investment. At the close of the June quarter, the total investment commitments garnered by AIFs jumped 20% on year to 8.45 trillion rupees, SEBI data showed. Some experts also suggest that financial institutions should provision the full amount of the investment in AIF rather than liquidate their investment to avoid any significant reduction in the value of their investment. Which is better, the provisioning or the liquidation route?
Now, the question here is not, which is better, provisioning or liquidation. It is about the time. Okay, if you look at practically, is it possible for anybody to, liquidate 100% of such investments in 30 days? That's slightly doubtful because these are close-ended funds and, which are given for a specific purpose, and they might have lock-in period, and there are so many other complications. So the NBFCs may not be able to liquidate in 30 days. So that leaves us with only one option. So a lot of firms are likely to go for provisioning unless RBI comes out with an addendum to the circular which says that, the timeline is extended for another 30 days or until 31st March or something like that.
In his speech earlier this year in May, RBI Governor Shaktikanta Das flagged the issue of the evergreening of stressed loans, talking about how lenders resort to various innovative techniques in order to conceal the actual status of stressed loans in their books. One of the ways Das highlighted was an instance of two lenders getting into a sale and buyback agreement involving debt instruments so as to mutually evergreen each other's loans. Days after the central bank's directive, Piramal Enterprises Limited and IIFL Finance informed the stock exchanges of having initiated the process for provisioning already, in compliance with the new RBI norms. Piramal Enterprises, along with Piramal Capital and Housing Finance, said their investments total about 3,800 crore rupees in AIF units as of 30th November 2023, of which 1,700 crore rupees are invested in debtor companies of Piramal Enterprises as of the last 12 months. Separately, IIFL Finance also disclosed a combined investment of about 21 crore rupees in IIFL Fintech Fund and an outstanding debt exposure of around 3 crore rupees linked to one of the fund's downstream investments. Industry experts are currently hoping to get further clarity from the RBI, especially on the timeline, since they feel 30 days is too short a period for exiting an investment. And even if they do so, they will have to bear a significant haircut in the investment value.
The timeline may indeed be clarified, but RBI's vigilant move will surely keep the evergreening of loans in check. More on that later in the show, but before that, we have for you an exclusive chat with Danat Dubashi, Managing Director and CEO of L&T Finance Holdings Limited. Let's listen in.
Hello and welcome to the Business Standard Banking Show. In the last few years, L&T Finance Holdings, an upper layer NBFC, has transformed itself into a retail lending organization from a wholesale one. Now, 88% of the assets of the company are to the retail segment. The man behind this transformation is L&T Finance's MD and CEO Danat Dubashi. He joined L&T Finance in April 2007 and is at the helm of the company since July 2016. We have Mr. Dubashi with us today to talk about his journey in L&T Finance. Mr. Dubashi, welcome to the show.
Thank you, and thank you for calling me, Manoj. Thank you.
In the last few years, a strategy roadmap, namely Lakshya 2026, was initiated. Where does L&T Finance stand in terms of achieving Lakshya 2026 targets?
See, Lakshya was, a strategy which was made from FY22 to 26, and that strategy was meant with only one goal, is to establish L&T Finance or transform L&T Finance into a digitally enabled, customer-centric retail finance company. You know that, just about 2 years back, 2.5 years back, we were almost a 50-50 wholesale retail company. We said that by March 26, we will become at least 80% retail. That was the first target we put. Then we can call ourselves a retail company. We will say we will grow retail because we didn't want to achieve that only by reducing wholesale. But we will grow retail book by at least 25% every year. And I will maybe talk about later on how we achieve that. Third was, while doing this growth, we should keep asset quality pristine. And because of that, we set a goal of that our GNPA, GS3 as it is called, should be maximum 3% retail, and your NS3, net stage 3, should be maximum 1%. And last but not the least, all of this should convert into profitability. Retail has already become 88%. And the chances are, not chances, we are confident that we will end this year at well above 90%. Very closer to, in fact, 95%. So that it is that successful.
Exactly, I'm coming to that. So you have overachieved your target 2 years before the date. So what next now for L&T Finance? What is the next phase of growth, say over the next 2 to 3 years?
Good. Very good question. So listen, Lakshya 26 is a 4-year plan and we will stick to it, right? But the very important part is we realize that what we have achieved today is in terms of ratios. All the ratios we have achieved, right?
Yeah.
The important thing is keep growing from here at this rate while keeping asset quality and profitability pristine.
Correct.
This is important, and hence the future strategy is all about sustaining this growth. And we have already put that strategy in place for the next 4 to 5 years also. And March 26 will be a part of it. This strategy is around 5 pillars. The first pillar is increasing customer acquisition even more. So right now we acquire close to 7 lakh customers per quarter, new customers. We want to, within 2 to 3 quarters, we want to increase it to 1 million. And then further 3 quarters, we increase it to 1.5 million and so on.
Right.
That is number one. And there are many businesses which are bringing in these new customers.
Correct.
Along with that, we also want to increase our upsell and cross-sell to good customers out of this. We don't sell any loans to delinquent customers. It is good customers out of this once they are tested with you to sell more. Now, the advantage of this, Manojit, is when you do it to your own customer, one, the credit quality is superb. So your collection cost, credit cost is good. But second, your acquisition cost is also almost 1/4 or 1/5 of if I acquire this customer from outside. So it is good for the profitability also.
Right.
The second pillar is making sure that our credit metrics and risk keeps improving from now, even further, right? And that is happening by tremendous use of public digital infrastructure. So data today is available, subject to the right secrecy and the right parameters abundantly and democratically in India, right? I'll just give you an example. Till 6 months back, banks could only access the deposit data of people, and I had to be satisfied only with income data or credit bureau data. Today, with account aggregator being introduced and working very well, subject to the customer giving me permission through OTP, I can access his bank accounts and analyze it. So this is just one example of how data is being democratized.
What is your loan book now and where do you see it by March end?
So retail loan book, I wouldn't be able to specifically talk about where I see by March end. But retail loan book in September, we were close to about 70,000 crores. To be exact, 69,500 or something like that. And we are very confident that we are growing by, more than 30% year on year. So we should grow. If we maintain that growth rate, we should be close to 80,000 by the end of the year, retail loan book.
What is the overall size of the loan book?
Overall, the wholesale is 9,500. And as I said, let's take 80%, 80,000 suppose we reach. And that is 90 to 93%. Then you calculate where the wholesale book will.
On that note, it was a pleasure talking to you, Mr. Dubashi. Thank you for speaking to Business Standard and wish you all the best.
Thank you.
Today, we are diving into recent changes in the financial landscape, specifically how the Reserve Bank of India is cracking down on a practice known as the evergreening of loans. It is a term buzzing around, and the RBI is taking some interesting steps to address it. So let's break it down.
Alright, let's start with the basics. Financial institutions employ the strategic approach to sustain the facade of a performing loan artificially. It involves the extension of additional credit to borrowers facing challenges in meeting existing repayment obligations. By facilitating new credit, the borrower can ostensibly service the outstanding debt, creating the illusion of financial health. For instance, consider Bank X extending a substantial loan to individual person Y for a real estate development venture. As unforeseen circumstances impede Y's ability to meet repayment obligations, signs of distress emerge, elevating the risk of classification as a non-performing asset or NPA. In an effort to avert the adverse repercussions associated with NPAs, Bank X extends another loan to Y, affording them the means to settle the preceding debt. This is commonly referred to as evergreening. Primarily, the objective of evergreening is to circumvent the classification of loans as non-performing assets on their financial records. Such classification can have deleterious effects on a financial institution's fiscal health and subject it to heightened regulatory scrutiny. By perpetuating the semblance of a robust loan portfolio, these institutions seek to uphold investor and depositor confidence. Now, before we get deeper into the RBI's move, let's talk about AIFs. That's short for Alternative Investment Funds. Think of them as the cool kids on the financial block. They pool money from different investors and play the market with strategies that are a bit off the beaten path. Venture capital funds, private equity funds, real estate funds, you name it, they are in the club. In a recent circular, the Reserve Bank of India has explicitly stipulated that regulated entities encompassing banks and non-banking financial companies are precluded from making any investment in schemes offered by alternative investment funds or AIFs that possess directly or indirectly investments in the borrower company. Imagine this. Bank A extends a loan of Rs 100 crore to Company X while concurrently investing in an AIF named Y. Subsequently, Y channels its investment, whether through debt or equity, into X. The crux of the concern lies in the potential utilization of funds acquired from Y by X to mitigate its exposure to Bank A. As a consequence, Bank A, instead of maintaining a direct loan connection with X, acquires an indirect exposure through its investment in L. So now, no such investments are allowed for banks and NBFCs. Now, what if Bank A has already executed its investment before the issuance of the RBI directive? In such a scenario, the RBI mandates regulated entities to divest their stake in such AIFs within a stipulated period of 30 days. Failing this, a 100% provision is necessitated for such investments. Moreover, it has been observed that non-banking financial companies and banks held junior or subordinated units issued by AIFs, while superior units were allocated to overseas private equities or venture capital partners. In response, the RBI has expressly prohibited regulated entities from holding junior or subordinated units.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So these AIFs are cool kids on the financial block, but must be mindful of the RBI's scrutiny. Moving on, I spoke with our consulting editor, Tamal Bandhopadhyay, on how the fintech industry is transforming financial inclusion. Here's the chat. Hi Tamal, welcome to the Business Standard Banking Show. This week in your column, you've talked about a very interesting aspect of what the fintechs are doing. Now, can you elaborate on how the fintechs are transforming the agenda of financial inclusion, which was originally started by the Pradhan Mantri Jan Dhan Yojana?
Thanks, Ruchika. Yes, what I have written is that, things are happening, but more needs to be done, particularly for the people in the so-called bottom of the pyramid. For you and me, everything is fine. UPI and Google Pay and money transfer through our mobile, these are all good. But if you go to the hinterland, I mean, the digital literacy is not very high. Things can be done even with feature phone. You don't need a smartphone. So this lot of ignorance about how to move ahead. And in that sense, I think it's little overhyped. Even if let's talk about PMJDY, what you were talking about. Now, this is the world's largest financial inclusion drive. Okay, I mean, 51 crore plus people have been covered by that. I'm not getting into whether it's successful or not, the kind of money there, and of course they get the government subsidy directly, leakages have been proved. All these things are different stories, but do they actually know what is the use? Most of the beneficiaries, like you can get an overdraft, okay? Many of them don't know, and they're scared to come to a bank to find out their balance, banking balance. They are not comfortable with doing transactions. So essentially, fintech is more hype than what we are seeing. That's what, and to be honest, these are all not my views. This is based on a book by Bhagwan Chaudhary, of professor of ISB, and one of the other gentlemen, two of them did they did extensive research in the hinterland across India, and there's a result. So many
You've
more
talked about, Tamal, you've talked about things like digital DD, balance, but you've said, voice features at ATMs, etc. How much of this is actually, translating to digital literacy and financial inclusion? And what more should the fintechs do?
Yeah, exactly. I mean, these are the ideas, and not all of them have been implemented. So what, like, for instance, for police, what number, 3-digit number, for ambulance, for fire brigade. Why not have 222 bank balance batao? Even on a feature code, you can do this. So anybody and everybody across India press this number and been told what's his or her bank balance. Similarly, why not make it absolutely necessary that every child born into a poor family gets X amount of money from the government to open an account, so that, along with the birth certificate, you have also bank account. So these things need to be done. Digital DD. Who is a digital DD? You could be a digital DD. A homemaker could be a digital DD. Even a high school student could be a digital DD. She becomes a digital DD the moment she wears a uniform. And this digital DD can help people in the hinterland for banking transaction. What is the balance? If they want to get money, if they want to pay back to the bank, etc., etc. Of course, I mean, they need to be responsible, and there are lots of checks and balances need to be there. But with slight, little bit of incentive, you can get digital DD. Similarly, like the book also talks about that, why not you have lenders who will be in the hinterland, who will be financed by banks, but who will be not as expensive or usurious as the money lenders. So there are multiple ways of doing things. And yes, we are doing pretty well, even by global standard. I think we have moved ahead tremendously on the digitization front. But there are more to be done, particularly for the poorer section of the society.
Absolutely. A lot of scope there. And the thing you talked about, digital DD, did remind me of the banking correspondents that are there in the villages to help people transact with the banks. Tamal, moving on to another development where it has been found that, according to RBI data, the liquidity deficit of the banks is highest in over 7 years. What is the impact of this? How do you see it?
So essentially, the sale of dollar, and as a result of that, rupee getting out of the system, and the high surplus with the government. These are the more critical. I mean, these are the two contributory factors, apart from public currency with public rising, and every month GST flow, and every quarter GST plus advance tax. Now, what is the impact on the market? You see, it's not like banks borrowing cost 6.75, which is the MSF rate has happened. Overnight money also now getting little more than that, say 6.995. But these are all in the ultra short term. even in the 1 year treasury bill yield is not reflecting anything. And of course, on the at the higher end, there is not much of impact. So I don't think we should be really concerned about that. RBI is there to open up its VRR, triple VR is that variable rate, and the market will have to pay. I mean, the banks will have to pay 6.75.
Yeah,
that's
absolutely.
it. In the short term, very short term.
That's very well put, very succinctly. What are the reasons why this has happened? And you've talked about the impact as well. Great ideas, Tamal, about financial inclusion. And hopefully, now that these ideas are out there, we will see some action on ground as well. Thank you so much, Tamal, as always, for sharing your insights. See you next week.
Thank you.
It is time now for our poll results. Here's what we asked you last week. Should public sector banks be allowed to decide employee salaries? 70% of our respondents said yes, but 30% disagreed and said no. How will interest rates pan out in 2024? Some experts believe it would stay at the current level, while others feel that the rates may increase. You can also tell us what you think when it comes to your loans. Here's our poll question for this week. Do you expect loans to get cheaper in 2024? Our poll is open today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, and our website. That's all we have for you today. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.